This goes back to a program, Greenspan initiated this, actually in 1994. He allowed banks to sweep. He says, well, let's let the banks make more money. So we'll let them sweep money out of their checking accounts and put it into savings accounts because they can lend from savings accounts. The reserve requirement on savings accounts, by the way, is 0. So if you've got money in your savings account and you think that money is there, well, not a penny of that is there. Mm-hmm. And with checking accounts, everything but what has been swept out is not there. The money's not there. Just pretend that it's there. It's all lent out. And if even a small fraction of people went to go get their money, it wouldn't be there. The deposits aren't there. When you have $6.84 trillion in deposits and only $273 billion of it's there, well, you got a problem.
Mish, it sounds like to me, if I was to wrap this up, because I want us to go on our final phase of what you see for the future here, it sounds like if we were to have a State of the Union, what you're describing, as I hear it, is sort of a perfect storm, where we have a required tightening of credit because people are just deaded out and can't take anymore. Mm-hmm. Therefore, when you go into that kind of deflationary environment, both businesses and people are drowned in their own debt, where they can't inflate their way out of the value of their debt. Their debt gets bigger and bigger and bigger on their shoulders. They're not even meeting their monthly expenses, much less addressing their debt. Now we have money that's been squirreled away in these various accounts that's suspect on whether people are going to even be able to retrieve the money they've made before, much less make any kind of notable money on investments because the investments are not taking off anywhere. It seems like to me that they've painted themselves into a corner where they've tried a lot of cute tricks over the decades, and now they're in the point where any way they go creates another problem, and we've gotten to the point of no return. Am I reading that correctly?
Yeah, absolutely. That is in a nutshell the thesis behind my theory called peak credit. That once that is reached and the banks are no longer able to inflate, that that's when the crash happens. And it can be a slow crash, like what happened in Japan. And right now, it looks like that's the way it's going to play out here, or it can be fast, or some combination thereof.
And it won't make it any less painful being a slow crash, right?
What was that?
It won't make it any less painful being a slow crash versus a fast.
Oh no, actually, it'll prolong things. We need prices. For example, we need home prices to fall to the point where they're more affordable. That's the only way that you can fix the housing market. Instead, we've got all of these schemes out there to bail out Fannie Mae and to bail out the banks, and they talk about helping the homeowner, but they're really not. It's a lie. And they say they want to help the homeowner. No, they don't. What they want to help is the bank. They want to make sure that bank gets their money back. They don't want the people walking away from their house. So they got all of these schemes to prop up the price of the house just so people don't walk away from them. So it's all of that does is just delay the eventual final outcome, because once the trend starts, it runs till exhaustion. Peak credit is hit, it's going to run till exhaustion the other way. And home prices are going to keep falling until they hit bottom. And when the government comes out there to try and prop up the price of houses, it's only going to delay the agony and probably put more people at risk. And certainly any money that the government is giving the banks, the Fannie Mae's, they're really trying to bail out the banks here, the bondholders on Fannie Mae. It's not the average person. The average person holds Fannie Mae stock. It's probably going to go to zero or near zero. They're going to bail out the bondholders. The bondholders are the banks, and also China. China is one of the biggest holders of Fannie Mae and Freddie Mac debt. So hundreds of billions of dollars, $300 billion that we know that they have. Is agencies, which is Fannie Mae and Freddie Mac securities. China holds. So when we issue checks, when taxpayers pay checks, a portion of that money is to go out, is to pay off China who's invested in is invested in Fannie Mae and Freddie Mac. That's where taxpayer dollars is going, to China. We're bailing out China right now.
Wow.
It's really sad.
What now? What about? I know a lot of your regular readers have been wanting to ask your opinion on this, and I want to sneak this in, and then I want to just focus on where you think things are going in the future. There was a recent announcement about some new gimmick that they have to try to address the problem or delay it further with something. I think they call it cover bonds or something of that nature. Do you know what I'm referring to? Yeah,
it's covered bonds. Paulson came out with that. It actually is probably one of the more reasonable things he said for two years. I mean, all he does normally is yap about the strong dollar. Covered bond is, right now the way the mortgage industry works is the banks originate a loan, they sell it to investors, and they didn't really care, or they didn't think they cared, what happened to the value of that loan. As long as it was off the books, they sold it to someone else, that they were fine. That's called an originate and securitize, or originate and sell the loan. The way that the banks and the brokers themselves got into trouble over that policy is they tried to keep all the good loans themselves, but they made a mistake on what constituted a good loan. They were left holding a lot of garbage themselves. And so here, while the average pension plan, average person, anyone that invested in this stuff that they were selling got totally hammered, it eventually came back and bit the hand that started this mess, because the crisis got a lot deeper than they thought it would. So they got burnt by their own greedy policies is what happened. And now, once again, those are the institutions that we're bailing out, those that got greedy and did this at taxpayer expense. But a covered bond says rather than selling that loan, the bank has to keep it on the books and be responsible for it. Well, as long as the bank's going to be responsible, for that, then we're not going to just maybe they won't do some of the ridiculous things that they did, which was lend money to anybody that could fog a mirror. They're going to pay more closer attention to what the value of that home is worth. They want a higher down payment. So I'm all in favor of covered bonds, although I've seen articles out there that are skeptical about the way this is being done, or more importantly, why this is being done. And the cynical side, here's the cynical side of the story of covered bonds, is a lot of people suspect that the good loans are going to be put into these covered bonds. Those good loans are going to go to the banks that the Fed wants to save. In other words, the J.P. Morgan, Citigroup, the like, the handful of select banks that the Fed wants to bail out. And so, all the other garbage is going to end up at Fannie Mae, and of course, taxpayers are going to be footing the bill for that one.
That's diabolical.
So, gosh.
Yeah, in theory, covered bonds is a good idea. The cynical side says maybe we should look a little bit closer at exactly what they're doing and how they're implementing this thing.
Okay, Mish, we're within 15 minutes here, so I'd like for us, since this is Future Quake, to focus on the future. And I hope our new listeners have appreciated our attempt to try to go back and reestablish some foundation, because when we have you back, Mish, we want to hit the ground running in the future here. Polish your crystal ball here. Given all we've talked about, what do you see probably is going to be playing out economically in the next 6 to 12 months and beyond?
Well, as I said earlier, I predicted unemployment to rise to 6% by the end of this year. Let's go one further and tack on another percent for next year, 2009. Put it at 7. And again, I'm talking about the official published report, not what the number really is.
The Pollyanna.
The Pollyanna number, yeah. The Pollyanna number will probably hit 7% in 2009. I don't think housing bottoms for 4 more years. So all these people that have been calling for the bottom in housing for the last 2 years, well, they've been wrong for 2 years. They're likely to be wrong for 4 more.
Whoa.
And the reason actually is quite simple. The economy is clearly contracting now. I talked about unemployment rising. Well, unemployed people can't make house payments, and we talked about Bennigan's, the service economy. The service economy is about ready to contract. This is a very key issue. Housing was the main driver for this economy for years. As long as homes were being built, people had jobs. There were tradespeople who had to work. There were plumbers. There were electricians. There were appliances. Even things like buying grass seed at Walmart, or things like buying a new appliance at Home Depot or wherever. All parts of the economy were humming. That was followed by, once the subdivisions were built, there was a build-up of commercial real estate. So we had the strip malls, the Pizza Huts, the Walmarts, the restaurants going in around that. And even as housing was imploding, the build-out of commercial real estate was still going on. And so that build-out of commercial real estate still provided jobs. So people, think, well, this economy isn't as bad as it looks. And I said, well, wait till the commercial real estate stops. And it has. Starbucks canceling, closing 600 coffee shops. Bennigan's, 300 stores closed today. And that's going to continue. And so commercial real estate and the value of commercial real estate on the books of banks is going to decline. And it was the small regional banks, a lot of them, most of them, didn't get involved in the housing debacle because most of them were on the originate to sell scheme that we talked about. They would just, they would take the loan as long as they could sell it to someone else. They washed their hands of it. And they didn't even keep any of the stuff on their books at all. So they were clean. A lot of these banks were clean. But they're going to get in trouble. They had to do something with their money. They got involved in all the local strip malls, commercial real estate deals, the building of condo towers that aren't complete, and some of them aren't going to be completed. They're probably going to be knocked down. So the next wave of things to come. So people are talking, well, the subprime crisis is nearly over. Well, the subprime crisis nearly is over. I agree. But the commercial real estate plunge, looking ahead, that's going to plunge. And looking ahead at credit card defaults, those are going to soar. They have to soar because we've already ascertained that there's no jobs, and people without a job, well, they can't buy the house, they can't pay their mortgage, but they also can't pay their credit card debt. So we're going to see more personal bankruptcies. We're going to see more write-offs of more credit. The waves that are coming are an implosion in credit card debt, an implosion in commercial real estate, and a massive rise in bankruptcies, which means another wave is coming still on the housing debacle. That's not a pretty picture.
And I think the banks are going to be sitting on a whole ton of real estate that doesn't have much value, they can't hardly give away?
That's exactly correct. It's happening right now. Merrill Lynch sold a bunch of CDOs, which is a collateralized debt obligation on bonds, for 22 cents on the dollar. And the interesting thing about that, the only way they could finance, the only way they could find a buyer for that, is they financed 75% of it. So in other words, they sold these things for, you do the math, they sold them for 22 cents on the dollar. They financed 75% of it. So it's multiply 0.25, which is the amount they got, by 0.22. They got 5.5 cents on the dollar if you go do the math. On billions of dollars worth of mortgage-related securities.
Is that why these guys get paid?
5.5 cents on the dollar.
Is that
amazing.
Why they get paid so much as CEOs is because of their incredible wisdom in managing these companies?
Oh, obviously. The sad state of affairs is any of these banks or any of these mortgage lenders could have been, the CEOs, the company could have been better run by any one of probably 24 bloggers. And that's a pretty sad state of affairs in the economy.
Right.
When random bloggers can run Citigroup better than Chuck Prince could. And that's just true. So we have those nasty things to look forward to.
Mish, how will this change our society? How? I mean, those are real tangible economic things, but how will it change who we are, our values, or the way we live our lives?